Gold crashed after this, and if you're watching, you probably felt it. Maybe you woke up, checked your portfolio, and watched months of gains evaporate in what felt like minutes. No war, no pandemic, no central bank surprise, no headline that justified what happened. Just a violent, merciless drop that left most people asking one question. What the hell just happened? This wasn't a pullback. This wasn't healthy consolidation. This was a forced liquidation event disguised as normal market behavior. And by the end of this video, you're going to understand exactly how it worked, who benefited, and why this pattern has repeated itself throughout history. You're also going to understand why the price you see on your screen and the reality of physical gold are two very different things. Before we go any further, let me be absolutely clear. This is not financial advice. I'm not telling you to buy, sell, or hold anything. What I'm doing is showing you the mechanism, the plumbing underneath the market that most people never see. What you do with that information is entirely your decision. If this is your first time here, this is Jack Goldsman. We don't do hype. We don't do clickbait predictions. We investigate the hidden mechanics of markets that determine whether you win or lose before you even place a trade. If that sounds like something you need to understand, subscribe now. Not because I'm asking nicely, because what I'm about to show you will change how you see every gold move for the rest of your life. Let's reconstruct the timeline. Because the devil isn't in the details, the devil is in the sequence. Tuesday, gold is sitting near recent highs. Sentiment is bullish. Retail traders are piling in. Futures open interest is elevated, meaning there's a massive amount of leveraged positions in the market. Everyone feels confident. The narrative is simple. Inflation is sticky, central banks are trapped, gold is the safe haven. And then Wednesday morning, before most traders in the Western Hemisphere have finished their coffee, the CME group, the exchange that controls gold futures, announces an increase in margin requirements. Not a small adjustment, a significant hike that forces anyone holding a leveraged position to either deposit more capital immediately or reduce their position size. Now, let me explain what this means in plain English. Margin is essentially a security deposit. When you trade futures, you don't pay the full price of the gold contract up front. You put down a fraction, the margin, and control a much larger position. This is leverage. It amplifies your gains when gold goes up, but it also amplifies your losses when gold goes down. And here's the critical part. When the exchange raises margin requirements, you suddenly need more cash in your account just to hold the same position. If you don't have that cash available, you have two choices: deposit more money immediately or sell. And when thousands of traders face that same choice at the same moment, they don't sell in an orderly fashion. They liquidate. They dump. They hit whatever bid is available because they have no choice. Thursday morning, the selling begins. Gold drops several percentage points in a matter of hours. The speed is what matters here. This isn't a gradual decline based on changing fundamentals. This is a cascade of forced selling that feeds on itself. As prices drop, more positions breach their margin thresholds, triggering more liquidations, pushing prices lower, triggering even more liquidations. It's a feedback loop, a trap door that opens wider the more people fall through it. By Friday, the damage is done. Gold has shed gains that took weeks to accumulate. Retail traders are shell-shocked. Financial media is running headlines about the gold bubble bursting. And somewhere, on the other side of these trades, there are institutions and sophisticated players who just bought gold at a significant discount from panicked sellers who had no choice but to exit. Let me give you an analogy that makes this visceral. Imagine you're renting an apartment. You've been paying your rent on time for years. Then one day, your landlord says the rent is going up by 40%, effective immediately. Not next month, today. If you can't pay the new rent right now, you're evicted. You have hours to leave. That's what a margin hike does to leveraged traders. It's not illegal. It's within the exchange's rights. But the timing, the magnitude, and the market conditions under which it happens, that's where the real story lives. Now here's where it gets interesting. The margin hike didn't happen in a vacuum. It happened when gold was at technically vulnerable levels, when positioning was extremely bullish, and when the maximum number of traders would be affected. Coincidence? Maybe. But let me show you the pattern. In 2011, during the debt ceiling crisis, gold was surging toward all-time highs. Retail and institutional money was flooding into the metal as a hedge against potential U.S. default. And then, almost surgically, margin requirements were raised multiple times in rapid succession. Gold peaked and then crashed nearly $200 in a matter of days. The narrative at the time was that gold was in a bubble. But the mechanism, the actual cause of the crash, was forced liquidation driven by margin hikes. In 2020, during the initial COVID panic, gold experienced extreme volatility. At one point, physical gold premiums, the price you actually pay for a real gold coin or bar, diverged significantly from the paper futures price. You could watch the futures price crash while physical dealers were charging massive premiums because actual gold was in short supply. The paper price said one thing, reality said another. And in 2008, during the financial crisis, gold initially sold off alongside everything else, not because people suddenly didn't want gold, but because leveraged players were forced to liquidate everything to meet margin calls across their portfolios. The mechanism was the same: forced selling, margin pressure, liquidation cascades. Once is an accident, twice is a coincidence, 3 times is a pattern, and we're well beyond 3 times. Let's talk about the distinction that matters most: paper versus physical. When you buy gold futures or gold ETFs, you're not buying gold, you're buying a contract, a promise, a financial instrument that tracks the price of gold but is not itself gold. The vast majority of gold trading happens in this paper market. Billions of dollars change hands every day based on contracts that will never result in physical delivery. And this is the key insight. The paper market can move violently, driven by leverage, margin calls, and speculative positioning, while the physical market, the actual metal, behaves differently. During the recent crash, while the paper price was collapsing, physical gold premiums held firm or even increased. Coin dealers weren't slashing prices. Mints weren't struggling to sell inventory. The people who actually wanted to own gold, not trade it, own it, were paying full price or more. The disconnect between screen and reality is not a bug. It's a feature of how this market is structured. And if you don't understand that distinction, you will make decisions based on a price that doesn't reflect what's actually happening. Now, I want to be careful here. I'm not saying this is a conspiracy. I'm not saying there's a shadowy group manipulating gold prices in a smoke-filled room. What I'm saying is that the structure of the market, the rules, the leverage, the margin mechanisms, creates predictable dynamics that sophisticated players understand and can position around. When you know that bullish sentiment is extreme, that positioning is stretched, and that a margin hike will trigger a cascade, you don't need to manipulate anything. You just need to wait. Or, if you have enough influence, you might be able to anticipate when conditions are ripe for such an event. The data is public. The positioning reports are available. The margin announcements are made by the exchange. Everything happens in plain sight. The advantage isn't in secret information. It's in understanding the mechanism while everyone else is focused on headlines. I know you're scared. I know you watched your account drop and felt that sinking feeling in your stomach. I know some of you are wondering if you should sell everything before it gets worse. I know others are confused, trying to figure out what's fundamental and what's just noise. And I know a smaller group of you understands exactly what I'm describing and has been waiting for this moment. Let me speak to each of you directly. If you're scared, that fear is natural. But fear without understanding is dangerous. It leads to panic selling at the exact moment when the smart money is buying. The question isn't whether gold went down. The question is why it went down. If the fundamentals that made you interested in gold in the first place have changed, if inflation is suddenly solved, if central banks have become fiscally responsible, if the debt situation has improved, then yes, maybe it's time to reconsider. But if none of that has changed, if the only thing that happened was a mechanical liquidation event in the paper market, then you're being asked to make a permanent decision based on temporary price action. That's a mistake most people make. Don't be most people. If you're confused, that's okay too. This market is designed to be confusing. The complexity serves a purpose. It separates those who understand the game from those who don't. Your job right now isn't to predict the next move. It's to understand the mechanism well enough that you can't be shaken out by events like this. Knowledge is the only edge retail investors have. Use it. If you already understand this, then you know what comes next. The question isn't if this will happen again, it's when. And your job is to be positioned in a way that accounts for this volatility. Whether that means reducing leverage, holding physical rather than paper, or simply having the conviction to do nothing when everyone around you is panicking, that's your decision. I can't make it for you. And once again, let me be clear, this is not financial advice. I'm describing a mechanism, not telling you what to do. Here's what I want you to take away from this. The price of gold on your screen is not the same as the value of gold. The price is determined by a market dominated by paper contracts, leverage, and speculative positioning. It can be moved violently by margin changes, liquidity conditions, and forced liquidations. The value, the reason gold has been money for 5,000 years, doesn't change because of a CME announcement. Understanding this distinction won't make you immune to volatility, but it will make you immune to manipulation through volatility. And that's the difference between someone who panics and someone who prepares. They'll tell you gold is volatile. They'll tell you it's risky. They'll tell you paper instruments are more convenient, more liquid, more modern. And they're not wrong about any of that. But they won't tell you that the volatility is often manufactured, that the risk is amplified by leverage most people don't understand, and that the convenience of paper comes with the cost of disconnect from reality. You don't fight this hard against something that doesn't matter. You don't engineer liquidation events against an asset that's irrelevant. The intensity of the mechanism tells you something about the importance of what it's trying to suppress. They call it volatility. I call it the system showing you its hand. So let me ask you directly, after what you've seen, after understanding the mechanism, are you holding, selling, or waiting? Drop your answer in the comments. Not because it matters what anyone else thinks, but because saying it out loud forces you to be honest with yourself about your own conviction. If this video made the markets make more sense, subscribe. We don't do this for entertainment. We do this because understanding the mechanism is the only way to avoid being a victim of it. Share this with one person you know who panicked during the drop. Not to say I told you so, but because knowledge shared is the only thing that can level a playing field this tilted. This is Goldsman, and I'll see you in the next one.